Hello, welcome to our video. Today we're going to be breaking down what investment risk really means, how to manage it, and why you must ensure the investment risk you're taking aligns with your goals and preferences. Quick disclaimer, I don't know you, you don't know me. This is general information only and not financial advice. Please always seek the assistance from a licensed financial professional regarding any investment matters. Now, what is investment risk? Essentially, investment risk is the chance your investment won't perform the way you expect. Now, this could be in the form of lower returns than initially planned, returns lower than inflation, or potentially the permanent loss of capital. Now, everyone has different motivations for investing, so it could be either towards saving for an emergency fund, towards planned purchases such as cars, a deposit on a home, holidays, or it could be to, for example, build wealth for retirement or pre-retirement, or even preserving wealth and achieving a passive income stream to support reducing your work hours. Now, depending on whatever your motives are, there are a number of considerations which need to be made before investing your money to ensure that it's done in an appropriate manner and avoid taking on too much or too little risk. So, once we understand why we're investing or what we're saving towards, we need to identify whether this can be achieved in a short period of time or a long period of time. So we need to identify a term horizon. Now, typically short-term investing or saving is over a 1 to 3 year period, and long-term is over a 3+ year period. There is also a common concept in financial planning known as risk tolerance. So this is essentially how much uncertainty or potential loss you're willing to accept for potential gains. And this is largely influenced by your goals, time horizon, and also your emotional comfort with investment volatility or up and down movements in your portfolio. So some common questions that you could be asking yourself around sort of your comfort levels on taking risk is, how do you feel when markets drop? Are you someone that's worried and checks your balance every 5 seconds, or are you someone that understands that investing is for the long term and these short-term fluctuations really mean nothing? Does it keep you up at night? Can you endure a fall in value on your investment? So could you survive a day in your shoes if you saw your investment portfolio having fallen 20% plus in a day? And how much of a fall would you be able to endure? So if you answered, I don't want to see any fall in my account balance, I wouldn't be able to sleep at night, then you're typically seen as a more conservative or defensive investor. Whereas someone who may say, look, I don't really care what my investments fall in value. I know long-term investments typically have historically gone up in value. I'm not fazed by investing, and look, even if fall in 15-20% in my portfolio over a given day won't keep me up at night, then that could be someone who's a bit more growth or high growth orientated. So they're taking on or happy to take on a bit more risk and endure those volatile periods. Now, a common terminology used in the financial planning landscape is risk reward. Now, what risk reward essentially refers to is, generally speaking, the more risk you take, the more potential investment return you could achieve. And this is because essentially there's a wider dispersion of return outcomes the more risk you take on, because you're being compensated for that level of uncertainty. On the other hand, it's the same goes with lower risk. So typically if you're investing in a lower risk product, you're going to be expecting a much lower return profile. So for example, money sitting in your bank account is going to be returning you, say, 3% per annum, versus potentially investing in the share market may return you much higher or even potentially lower returns, because there's that higher risk associated with that asset class. So what we look at as financial planners is essentially we need to understand what your risk tolerance is, your investment time frame, and match it with a asset allocation framework. So we've got different frameworks from secure, which is on the far left here in front of you on the screen, all the way up to high growth. And typically, the more growth you're taking on, the longer the investment time horizon is. So think high growth, 5+ years. Then you've got your secure, which is short term. You're thinking, 1-2 years. And then you've got your in-betweens there. Now, essentially what happens is, if we're invested over a very short period of time in, for example, high growth investments like shares, we're going to be potentially seeing huge variety in our investment returns over that short period of time. Now, if we improve or increase our investment time horizon to say 3 years, what happens is we actually narrow down, on average, the up and down movements in your portfolio. So you can see that represented in the green, yellow sort of box, where the average investment returns are much more compressed in comparison to the 1 year returns, which is showing with that blue line, which can vary from up to 23% to as low as 5%, -5% return. So we need to really understand how long we're investing for, understand the risk we're taking, and the potential variation. Now, I'm going to sound like a broken record here because I think I use this word about 50 times a day with my clients, but diversification is absolute key when it comes to managing risk as part of your portfolio. So we really need to understand what each asset class has done historically in relation to the level of volatility or risk and what it's returned to us. And from there, what we can do is we can construct an optimal portfolio which aligns with your expectations, goals, and also your risk tolerance. If you're a conservative or defensive investor, you're not going to be putting all your money into Australian listed property or Australian equities, because the volatility or the risk you're taking on is much, much larger than, say, cash or diversified income, which may greater align with your preferences. On the other hand, if you're a high growth investor and love taking risk, well, you wouldn't be putting all your money in cash and global fixed interest, because the returns profile is much lower than, for example, a global equities or a global listed infrastructure allocation. So what we do is we identify where you're at, what your goals are, and we construct a portfolio which incorporates a number of these different asset classes so we don't have all our eggs in one basket. And the idea is that we're mixing and matching asset classes and weightings towards these specific investments to ensure that we're allowing you to achieve your goals whilst also minimizing investment risks. So diversification is probably the most important aspect that you need to be aware of when building a portfolio. I've seen it all too many times where clients put all their money or had put all their money in the wrong asset class, and it really severely detrimented their position, especially if it never went to plan. Now, we're going back to quickly discussing about the investment time horizon, and I just wanted to show you this graph, which is probably one of my favorite graphs here, that just demonstrates the reduction in the perceived volatility when you hold an investment over a 5-year period versus a 1-year period. I mean, the return profiles over a 1-year period, for example, with the Australian 300 index, which is what we're using here as a proxy, is just huge. In comparison to if you were invested over a 5-year period, it really does average out those up and down movements. So again, we're really needing to understand our investment time horizon and match it with the correct asset class and product, because ideally we don't want to be investing in shares if we need to access the cash in 1 year, because as you can see, over a 1-year period we could have a 30% return or we could have a negative 40% return. So really, really be careful with how you're structuring your portfolio and aligning it with your investment time horizon. So I hope this video gave you a bit more of an insight into investment risk, what different asset classes can do to your portfolio in terms of providing or reducing volatility and potentially enhancing investment returns. And if you've got any questions, always feel free to give us a call, 9078-6454. Always happy to answer your questions and assist where needed. Thank you.